My name is Damian Sassower. I am the Chief Emerging Market Fixed Income Strategist for Bloomberg Intelligence. And we're going to give you a bit of a taste of the way an institutional EM creditor might view Qatar in the current environment. So before we do anything, what we like to do at Bloomberg Intelligence is we like to decompose returns into their sum of the parts, right? What are the factors that are driving the $2.1 trillion market for EM dollar debt, right? So there are three things. It's going to be spread, duration, and carry. Carry is coupon income. That's easy. Spread is, duration is returns that are due to the shifts in a yield curve, specifically the U.S. Treasury yield curve, because what we're talking about here is only U.S. dollar debt. And finally, we have spread. Most people try to think of spread as the fundamental risk that's embedded within a bond. Well, that's not true. It's a lot of technical risk as well, and we're going to get into that in a bit. So what you could just see here, if you bear with me, is in the white you've got your coupon income, in the different colors your regional spread returns, but this orange is the real key here. The returns that are attributed to falling U.S. Treasury yields is unlike anything we've ever seen in EM dollar debt, and this goes for all spread-related asset classes across the whole of U.S. credit, be it IG, high yield, et cetera. So obviously, if duration is the big driver, you better have a position on where U.S. Treasury yields are headed in the current environment, right? And so what we see here is that consensus is calling for higher yields from where we are today, which would amount to a negative 37 basis point decline in EM dollar debt through the end of this year. EM dollar debt, by the way, is up 10.9% year to date, which is an absolutely exceptional return given where we are in the environment we're living in. Bloomberg Intelligence is actually calling for slightly lower yields from here, so hence the reason you see 4 basis points of positive return attribution through the end of the year. But what is really all driving this? What we see in EM dollar debt is something called the quality premium. Basically, the differential between high yield, i.e. more risky, and investment grade, low risk EM dollar debt has exploded, and it's 3 standard deviations above historical record. I'm talking 20-year history, and this is also something that's not just EM specific. It goes for the whole of U.S. credit. Basically, what we're seeing here is in an environment where growth expectations have gone down. I mean, we can actually decompose U.S. Treasuries into two things: inflation expectations, which are inflation break-evens, and real GDP, real yields, basically, which is forward-looking growth expectations. And what we see is the move in U.S. yields this year is entirely due to falling real yields, i.e. falling growth expectations. So when recessionary risk goes up, the search for yield can only go so far. And so what we're seeing is this divergence between high-yielding risky debt and investment-grade quality debt, and you can see that here. And basically what this means is, and unfortunately my little pointer doesn't work, EM high-yield sovereigns are basically yielding far more than any other fixed income asset class over the better part of the year. This is the change in yield year to date, basically. So Fed funds, yeah, we've cut a few basis points here, sure. U.S. leverage loans, which are basically short duration paper, obviously has lagged. But EM high-yield sovereigns are one of the few asset classes that have really lagged this year. And so, again, one of the things we're seeing in terms of the quality premium, people not really reaching for yield into the riskier parts of the credit spectrum for fear of the fact that fundamentals are deteriorating. Much of this is obviously due to Argentina. I don't know how many of us are familiar with what's going on in Argentina. I'm actually boarding a flight for Buenos Aires this evening. But the fact of the matter is, Argentina is responsible for much of the $85 billion to $180 billion jump in 7% yielding EM dollar debt, and it's all high yield. So think about that. You can actually clip a 7% coupon in dollar terms by investing a lot of this high-yielding paper, but it is fraught with risk. So look, we could talk about duration until we're blue in the face, but the reality is spread historically has been the biggest driver of EM dollar debt returns, the $2.1 trillion market. And really, if we all sat here on the back of a napkin, I can tell you 4 factors that are going to drive upwards of 100% of all spread movement over the better part of the last 10 years. They are U.S. financial conditions, China, oil, and industrial metals. And of those 4 factors, China and oil have by far had the most overriding impact on EM dollar spreads over the better part of the last 10 years. I'm sorry, so what we're seeing here effectively, we don't just look at crude oil front month contract. We like to look at the 1-year Brent crude calendar spread. Why, you might ask? Because it tells us what the market perception of the supply-demand of oil looks like over the better part of the next year. And so what we look at here is the big strong correlation between EM dollar spreads or EM hard currency spreads and Brent crude, which is now at 12% backwardation. China. So what we're looking here as a proxy for China's sovereign credit risk, or 5-year CDS. And what you notice here is that the correlation between all of the biggest trade partners, and by the way, all of these countries listed below, 10% of GDP plus is attributed to trade flow with China. And as you can see, the correlation between them and China sovereign risk has gone up quite significantly. And so again, as goes China, so go the emerging markets. So now we're looking at EM local debt. EM local debt has 3 primary drivers, slightly different than that of EM dollar debt. The first is currency, which has historically been the biggest driver of all EM local currency government bond returns over history. The second is, again, carry, which is your coupon income. And the third is duration. But here, because all of the bonds are issued in local currency terms, the US Treasury curve really shouldn't have any impact whatsoever on duration returns. It should be the returns and the movements in each of those specific domestic yield curves that are driving returns. And lo and behold, we see again, duration has dominated total returns year to date. Why? Because emerging market central banks are following those of their developed market counterparts in cutting rates. And so what you have here are developed markets sort of rolling over. You have EM central bank. This is basically the average policy rate of central banks globally. And this is including Turkey and Russia, which is a little bit more risky. But just going back here, what you see is, yeah, okay, fine. You've got some currency losses, but in white, you're looking at the impact of duration gains in EM local currency markets year to date. I mean, we've never seen anything like this. We've never seen broadly across all of the 21 constituents in EM local currency investable debt, we've never seen duration gains across the board, across each and every country in our market. I mean, that's kind of unprecedented. I mean, we're used to seeing currency risk all over the board. We're obviously coupon income. It's one of the highest yielding markets. We should see returns there, but the duration gains leave something to be desired. And so just looking here and fast forwarding, you know, what we're looking at here in orange is the 2-year real rate, because basically, if you have high real yields, you have more scope to cut rates if you're a central bank. And here you're looking at expected versus current year-end policy rates for most of the markets. And what you find is it's countries like, again, Mexico, Brazil, India, the Philippines. All markets, by the way, Mexico and the Philippines are expected to cut this week alone. And in Brazil and India, they've been cutting and are expected to do more. So you can see that emerging market central banks are really following the developed markets in slashing rates to stimulate their local economies. Why? Because there's no growth anymore. But this is the real problem if you're investing in EM local currency markets today. Okay? The fact of the matter is this: you don't get paid in dollar terms for owning local currency paper anymore. You get paid more for owning their dollar debt. Think about that. You can actually own the risk of investing in an emerging market country without taking on the currency risk. In fact, you get paid more for it in the current environment. That's kind of unprecedented. And certainly it's a misnomer and an anomaly that is not going away soon. I mean, we've basically been pointing this out for some time, and it continues to get worse. What we're looking at is duration-adjusted yield differentials between the Bloomberg Barclays EM local currency bond index and the EM US dollar aggregate. So, how would we approach EM local currency markets? We would do it on a diversified basis, right? We diversify across our funding currencies, right? You can't just invest from the perspective of a dollar investor. We would advocate that perhaps you diversify your funding currency exposure across the euro, the Swiss franc, the Japanese yen. And what you can see is if you do that, you get a much bigger absolute as well as risk-adjusted return. So let's talk about the drivers, yeah? So fundamentally, EM should be less exposed to exogenous external risk. Why? Because they've actually taken advantage of the low yielding environment, the negative yielding environment, to improve their debt profiles. So if you basically look at this, what you're seeing is that external debt has basically, your external debt ratio has declined from 10.7 to 10.2% for the major emerging markets. And the reason for that is they've been able to issue more local currency bonds. There's a bigger market for it domestically, and that's basically where they've been levering up, and as opposed to just issuing in dollar debt, which exposes them to external risk. So you would think they'd be a little less prone to some of the exogenous variables that are impacting many of the markets globally today. And as we see, while many markets have done poorly, quite a few have done rather well in terms of lowering their funding costs and extending their maturity profiles. And that's what you're seeing here, some of the countries that have been successful in doing that over the better part of the last year. Rating migration, I don't put a lot of stock in what the rating agencies say, but the fact of the matter is this: 3 out of the 4 regions, you're seeing rating trends deteriorating, Eastern Europe being the one outlier. Certainly in the Middle East and Africa, which is of most importance to us, we did see things start to improve, but now we see them rolling over, i.e. the geopolitical risk premium is back in play. Fund flows, obviously it's important, but fund flows track returns, right? So if you're looking at emerging market debt returns, it would make sense that, as we see returns sort of flattening out or going down, that fund flows are going to decline off the back of that, and that's kind of what we're seeing there. And now we look at Qatar. So in our mind, Qatar, as we all know, is an A+ rated sovereign credit. It is high quality. It is high grade. But as an institutional US dollar creditor investing in Qatar, what's your view of the credit? What does it look like? Well, obviously, if you just look at the fundamentals, you look at the fact that it has, in fact, stabilized its fiscal budget as a percentage of GDP in recent years, and you find that basically, just in terms of real GDP forecasts, 2.5% for year-end 2019. These are consensus, not Bloomberg intelligence. It's still one of the fastest growing economies in the Middle East, so things appear to be going well. Trade flow, obviously, during the brief stint when the blockade was introduced, we saw them go into a current account deficit. We're now at 9.3% current account surplus in Qatar, which is obviously quite good, and we see trade flow increasing. So, just looking through the full end of this year, we do expect a 6.1% current account surplus in Qatar through year end. Qatar's maturity profile. Qatar has basically done a really great job, again, of lowering its funding costs, its fixed coupon weighted average, and extending out its maturity and taking advantage of the low yielding environment. Again, as a sovereign credit analyst, we like this. This is good. All right, here's where things get a little messy, right? Because like most markets, Qatar is obviously tied to the whims of, its trade partners, of which Asia is its primary trade partner. In fact, as we all know, South Korea, Japan, China, and India make up upwards of 60% of trade flow with Qatar. And all of those economies are doing quite poor. I can speak to high-frequency activity data. I can talk to PMIs. I can talk to trade flow. We can talk to the U.S.-China trade war. But by and large, what we're seeing here is that Qatar is very much exposed to Asia, and how it kind of benefits or doesn't benefit from it remains to be seen. The one thing we can say is, just looking at the high-frequency data, China-EM trade's actually up year over year despite the trade war. And EM is taking up quite a bit of that slack, which is actually a good thing and may very well be a bonus for the Middle East and for some economies like Qatar. Another little kind of nugget that we like, that's caught our attention, is the fact that the Qatar inflation differential has basically gotten squeezed. And so what does that mean? It means that selling prices, if you just look at PPI, it's declined at a much greater pace than CPI. So PPI is the selling prices for corporates. CPI is basically disposable income domestically. And if your domestic economy is unable to consume as much as it did in the past, and oh, hey, by the way, producers aren't getting paid for what they were selling previously, you're going to see margins get compressed. And we feel this is a risk to Qatari equities and other corporates operating domestically on the ground. Just to give you a sense of where we are in terms of sovereign credit risk and the perception therein, this is the Qatar US dollar CDS curve. It's completely shifted lower, which is good. It means that it's got less sovereign risk, and it's actually flattened, which means term premia in Qatar is no longer nearly as risky as it once was. And I'm going back 4 years, 3 years, and so on and so forth. Here, what you're seeing is just the 5-year CDS spread, obviously very correlated to places like China and even Saudi Arabia. And obviously, sovereign risk is declining. Finally, what we talked about earlier, in a world where the quality premium is now becoming everything because growth is falling out of bed, there are opportunities, we believe, to get stable carry and take a defensive approach in emerging markets. And we believe Qatar fits really nicely into institutional portfolios with this one goal in mind. We're talking about an A+ stable credit and obviously a pretty volatile part of the world, But nevertheless, if you just look at it, its sovereign curve in dollar terms is far less risky than that of Saudi Arabia or even the Dubai government bonds curve, right? Now, this has a kind of a little bit of another implication, the fact that you don't get paid as much for owning Qatar bonds as you would for KSA and maybe Aramco and some others. And certainly the GREs, and we can talk about Razgas, and we can talk about Ooredoo, and a lot of the corporates that are big dollar issuers. The fact of the matter is, you just don't get paid. I mean, what we're looking at here is the Ooredoo curve relative to the Qatar sovereign curve. And it is kind of, you are getting a little bit of a pickup by going there, but certainly not as much as you would have if you were investing in, say, I don't know, Saudi Aramco in the current environment. So it's something to be taken in conjunction with the fact that, yes, while it is safer, you don't get paid as much of a premium for investing in these markets. Yeah. So basically, that is the whole of my presentation. I tried to keep it tight because I knew we were running over. But if you guys have any other questions, please feel free to reach out to me. I'm at your disposal. Thank you so much for your time.